fun to see some enthusiasm and excitement on the campus, but, you know, you can't sit on the market. I mean, I don't know that long.
You got those cameras in there. You got cameras in microphones and everything. But those are the two indicators that we judge the Fed on, right? Those are the metrics that we sort of say, this is your job. You have a dual mandate. And looking ahead, we may be able to say that we believe that this is coming down. But Kelly, 2-3 years ago, did anybody predict we were going to 9% inflation and a peak? As much did anybody. And then did anybody predict that when we had that happen, that inflation expectations at the long end would never even budge, right? Even the long end expectations didn't move, just the short end. So the Fed's, I mean, it's got the credibility where it wants it. It doesn't need to take that risk. It's got a labor market that is still extremely strong. I'm not exactly sure why you need an overreaction. Honestly, I think the best argument for why you don't go zero or sort of stand up and yell fire again is the market looks to the Fed as knowing more than it, even though they're probably wrong. And if the Fed is going back and saying, you know what, we're not going to tighten, even though we were talking about 25s and 50s because of this, the market's going to think the problem is far worse than it is. And right now, this is a confidence issue more than anything. All right. It's a confidence on the deposit side. And I think the 25 actually, in a strange way, is a confidence boost that they can handle it. They have the tools to handle it, even if we can find ourselves in new territory in a couple of weeks dealing with crises we don't know.
Well, again, kudos for basically highlighting the problem that we were about to go headlong into. Dave, thanks for coming back to join me today. I appreciate it.
Always a pleasure, Carol.
David Zervos with Jefferies. Now, in the meantime, in reaction to what's happened with the Fed, there's this huge split over tech right now. The bulls on that trade saying it should benefit from a less aggressive Fed, from scarce broader economic growth, pushing people back into names that are still posting growth themselves. The Nasdaq up more than 4% this week, outperforming the S&P 500. The bears, meanwhile, warning that big tech's best growth days are already over, especially post-pandemic, and that advertising-reliant names will suffer from an economic downturn. My next guest says tech is getting into motion here, and he's been trimming his exposure. Let's bring in Jason Ware, partner and CIO of Albion Financial Group, along with James Chudmug, who's been buying more tech names here. He's partner and portfolio manager at Clockwise Capital. Welcome to you both. James, I'll start with you. Conviction across tech here, or is it more specific?
No, definitely not all across tech. We're actually net bearish on most of the indices. We do think that Nasdaq will increasingly bifurcate away from S&P and Dow, but do think that you got to be surgical when it comes to picking the names. But I think when you look at the long-term opportunity across tech, I think the opportunities across AI, productivity, and what have you are undeniable, and I think that secular trend will continue. But that being said, over the short term, I mean, over the medium term, I think you got to be cognizant of recession factor in the second half. But the short term, with the terminal rate at the end of the year, 5.5% to 4%, and the future's expectations, I think, is a near-term boost. And what you've seen across a lot of these high-quality names, particularly the ones in our portfolio, is that the multiples are arguably dropped in most cases. So long as those growth rates over the next couple of months do remain resilient, which we do think will be the case at those drop multiples, I think you have a window here over the next couple of months where select names, the highest quality names, and those drop valuations will continue to outperform higher, including and then Amazon.
Sure, those are two of your biggest holdings. You've got Uber, Nvidia, Microsoft in there as well. Jason, you've been trimming Microsoft among other names. Why?
Yeah, so, I want to be very clear. We are not bearish on tech, especially large cap, mega cap technology. We've owned them, as you know, for well over a decade. We've been overweight and quite bullish on the space. What we've been recognizing over the past many months is twofold. One, there's a short-term view, which is our base case is that we're going to see a recession at some point here in the near future, and that's going to leave another leg lower in this bear market, and therefore having a little bit more of a defensive tilt, defensive posture in the portfolio makes sense. So we've been farming some of that for a mega cap tech at higher valuations. Microsoft, for example, this week pushed up above our price target to trim. We did that. It's trading at over 30 times earnings and over 10 times revenue. So we have very simple questions on mega cap tech going forward. Not bearish, again, just right-sizing these positions. business just to be a little bit more market neutral within the context of a macro environment where we see structurally higher interest rates over the next 5 to 10 years, where we see inflation not being 1 to 2%, but instead 2 to 3% over the next few years, and that has real implications for valuation. So with Microsoft, for example, here's a $2.1 trillion market cap, and we ask ourselves very simple questions like, what's it going to take from Microsoft after a decade of incredible growth to double from here, and over what time frame?
Sure.
And our answers today are different than they were when this was a $200 billion or $500 billion market cap. So again, still like these businesses, they need to be part of an investor's portfolio, just a smaller sizes.
So amongst the trimming, you've also outright sold Applied Materials, WCLD, and Adobe. I mean, Adobe is a name a lot. Look at the reaction to earnings. It seems like a stalwart.
Right.
Maybe you're getting an opportunity to break in at a lower price here. Why isn't that one that you want in your portfolio right now?
Yeah, so to be clear, we sold Adobe higher. It was a while ago. That was middle of last year. So again, as we look at some of these higher valuation tech companies, and Adobe is an example of one. It's trading, when we sold it, it was trading almost 40 times earnings and had a revenue multiple that just we were not comfortable with within the context of what is clearly a slowing growth business. Look at what they did with the Big Mac acquisition. I mean, they paid 50 times. They basically paid a 2021 multiple in 2022 for a business because clearly their core business is starting to see competition and growth. So as we square valuation relative to what we think earnings power looks like over the next 5 years relative to the past 5 years when we owned Adobe, to us it just didn't make sense to continue to own those types of names within the context of a macro that's clearly changed as well.
James, I'll give you the last word.
Yeah, look, volatility can be your enemy or it can be your friend. I actually think that the issues that we're seeing in the financial sector could possibly be a blessing in disguise in getting the Fed out of the way. And acting, as you were saying in the prior segment, a more data dependent and actually, letting the economy self-correct. That being said, I think as long as you have to be agile in this market, you can't. The days of I think buying a stock and holding it are gone, at least for the foreseeable future. So as long as you're disciplined with your entry and exit points and size things correctly, I think there's a lot of opportunity within the tech. And I think over the next couple of months, I think those select group of companies will, like the ones you just named that we hold, will continue to outperform. So we're buying where we can.
All right, we'll leave it there. Thank you both. Great perspectives today, James Chudmunk and Jason Ware. Still to come, beauty bonds are supposed to be one of the safest places to put your money, but did SVB's failure reveal a flaw in the system? A look at the staggering stats and what it means for investors relying on those returns. Plus, the past 4 sessions have seen the highest volume days of the year for S&P 500 stocks, and it's all leading up to today's quad witching. We'll look at the options action, what it means for the market, with the S&P below its 200 and 100-day moving averages. And as we get to break, let's get a closer look across the markets. 10-year yield, by the way, down below 343. The Dow down 1%, same for the NASDAQ at 39.22. I'm sorry, for the S&P at 39.22. The NASDAQ composite down 0.2%. A lot of pressure, again, on the Russells down more than 2%. And let's get a quick look at Credit Suisse. Those shares down 7%, down 25% since Monday. This was after the backstop by the Swiss authorities. Credit Suisse having its worst week since 2008. The exchange is back after this.
This is The Exchange on CNBC. Grab your green, raise a glass, and tap in to the sounds of St. Patrick's Day. Wherever you go around the world to find an Irish home. Rollicking Irish anthems from the Pogues, U2, Dropkick Murphys, and more on St. Paddy's Day Radio. All day today on Channel 28, and hear even more in the SXM app, including a special mix of essential Irish pub songs, included in all trials and popular plans.
Let's face it, talking about life insurance is never easy. But after we watched a close friend lose her husband with no insurance, we decided that wasn't going to happen to our family.
Yeah, but shopping for life insurance can be almost as difficult as talking about it.
But then we heard about Ethos Life Insurance. They're a new kind of life insurance, built for people on a busy schedule who don't have time for unnecessary doctor's visits, fine print, or hidden fees. You know, who want to keep it simple.
I couldn't believe how easy it was. We answered a few basic questions, and within minutes, we had an estimate of what it would cost and what sort of policy made sense for us.
I never imagined a life insurance could be so affordable.
And accessible.
The peace of mind knowing that our future is secure, it just removes a lot of the fear around getting older.
Yeah, the unexpected.
I'm glad we talked about it.
I'm glad we went with ethoslife.com.
Go to ethoslife.com now for your free estimate. That's ethoslife.com. ethoslife.com. You want your business to succeed, but need working capital to get things moving. The financial assistance your business needs is waiting for you at Everest Business Funding, your #1 trusted source for all your business funding needs. Just go to myeverestfunding.com or call 844-FINANCE. You'll see just how easy it can be to get funding. Everest Business Funding helps business owners get the fast working capital they need with a hassle-free application and no hard credit checks. Everest has the best deals for your business needs and fast funding, usually the same day. Everest goes above and beyond traditional funding providers because they want your business to succeed as much as you do. Grow your business with Everest Business Funding, helping business owners get ahead with fast working capital. Learn more at myeverestfunding.com or call 844-FINANCE. That's myeverestfunding.com or call 844-FINANCE.
Welcome back to the exchange. Muni yields holding steady despite the ongoing bank turmoil. Even though investors have been concerned banks like First Republic could offload those assets for cheap, that's because they're not included in the Fed's new bank term funding program. And according to the Wall Street Journal, First Republic held more than $19 billion worth of munis at the end of 2022. And in fact, nearly $4 trillion in outstanding muni debt has banks with about $600 billion of that, a little bit under, and the regional zoning close to $140 billion. So is there reason for muni investors to still worry? Let's ask Tom Kozlik. He's head of muni strategies and credit at Hilltop Securities. Tom, it's good to have you here. Welcome.
Thanks for having me back, Kelly. I appreciate it.
I think we need to explain to people just how interconnected munis are between kind of state and local government funding and the banking system. I mean, this isn't just, hey, by the way, on the side, this is happening. This is actually, unfortunately, a pretty important occurrence here.
Yeah, and in the conversations I've been having with investors this week, one of the main things that I'm doing is recognizing and acknowledging how stunned and really disoriented a lot of the municipal investors are who I've been talking to. I'm explaining to them that we need to be realistic, that we don't necessarily know everything that's going to be playing out over the next couple of weeks or couple of months, that we don't know if what happened last week and over the weekend is going to snowball. I'm not seeing cracks in muni credit quality, but as you described, there is a really strong, an underappreciated interconnectedness with large, medium, especially some of those small banks and public finance. And right now, we're talking to investors about being cautious, a little defensive, but we also don't want them to miss any opportunities.
Yeah. Talk to me about kind of 2008 or past periods of credit strain. What's happened with munis?
So we saw, now this is close to a worst case scenario that we saw in my mind playing out through the summer into the fall, the winter of 2007 going into 2008. And it was oftentimes, in that period of time, there was a lot of, it was difficult for liquidity, for issuers to get liquidity during that time. Yeah. From an investor perspective, MT or municipal to treasury ratios, especially after Lehman Brothers, they really widened out, and that there was some opportunity there. And that's one of the reasons why we're asking investors to stay defensive. For months, I've been talking to investors about using this opportunity to trade out of credits that might be a little more problematic and into credits that are stronger. Now I'm doubling down on that, but also asking folks to be a little more defensive, to really stay in highly rated GOs and revenue bonds.
Sure, no, it's a great point that if you're on the sidelines, you start to see these yields spike at all, maybe there's an opportunity depending on the credit quality. Let me talk with the last question that I have for you, at least today, because I think that we'll be talking about this for quite some time. What is the risk here as it goes back to issuers? In other words, what starts as this kind of wacky, almost esoteric thing at Silicon Valley Bank or maybe at First Republic, as the banking system kind of gets a little bit unsteady, let's say, how does that reverberate back to the ability of a lot of, governments, projects, whatever that is, to finance themselves, ironically, at a time when we're doing this massive infrastructure support?
Yeah, that the unsteadiness that you're describing, the way that that plays out for issuers is that if they don't have access to the liquidity, whether it be in letters of credit or other types of liquidity from banks, then it's difficult for them to conduct their day-to-day business. Now, I'm not seeing that quite yet, but that's one of the things that I'm remembering, again, very clearly. That happened at the end of 07 and into, if not all of 08. So if things snowball from here, that liquidity could, I don't want to say completely dry up, but be more difficult, especially for the smaller and medium-sized issuers to attain.
And when we see that munis are available but not accepted through the Fed's new program, is that because they can't accept them? Do you think that's what drove some banks to the discount window where munis can still be accepted?
I think that one of the things that we haven't been seeing this week. We've been seeing two things. The first thing is that there has been, as part of this flight to quality that we saw in the beginning of the week, we did see a lot of buyers, not just like banks, but buyers on the institutional and the retail side. They were, even in some cases, putting some cash to work in munis. They, instead of having their money in cash, were choosing to look at municipal bonds. And I think that one of the reasons for that is just because of the strong credit quality and because they were seeing that as an opportunity. I think that there are going to be times over the next couple of months, if not next couple of weeks, where that's going to continue.
All right, Tom, thanks so much for joining us today. We appreciate it.
Thanks, Kelly.
Tom Kozlik with Hilltop. Coming up, another outperformer this week has actually been the cloud stocks. The cloud computing ETF, SKYY, still up 5% since Monday. We'll hear from a leading voice in that space next. On the flip side, check out some of the losses in commercial real estate. These are week to date. SL Green, Boston Properties down more than 20%. Another worry for regional banks with similarly high office exposure, by the way. The exchange is back after this.
Wesley Financial Group is not a law firm. These are tough times for everyone, so dealing with your timeshare may not be your biggest concern. But when this passes, do you still want a lifetime of payments, fees, and commitments for a timeshare you were misled into buying?
Hi, I'm Chuck McDowell, CEO and founder of Wesley Financial Group. 10 years ago, I started the timeshare cancellation industry by exposing the ugly truth about timeshares and giving folks the straight facts. I've been fighting the timeshare giants ever since, so no one knows this industry better than me and my team. Today, we have saved our clients an average of $65,000 in lifetime payments. Imagine putting those timeshare dollars back in your pocket. Give my office a call today. I guarantee if we take you as a client, we will cancel your timeshare or you'll pay nothing.
Call Wesley Financial now for your free information kit. 800-885-8100. That's 800-885-8100. 800-885-8100.
Hi, Gwyneth Paltrow here. We do everything with our hands. Type, text, chop, mix, cook, open jars, play music, drive places, day in and day out, every single day. So when our hands hurt, we can't do anything. And that's why I love CopperFit hand relief compression gloves. The open finger design lets me type and text with complete freedom. And that gentle hug the compression gives my hands, what's not to love about that? But the non-slip grip in the palm, that's pure gold. That lets me keep a firm hold on the steering wheel, phone, or whatever I'm trying to grip. CopperFit hand relief is a necessity for me, and they're pretty cool looking, which makes wearing them even better. CopperFit hand relief. Give them a try. You'll love them.
Get yours today for only $19.99 at CVS, Rite Aid, Walgreens, Target, or Walmart. Or go to copperfitusa.com. Individual results vary and results are not typical. For more information, visit copperfitusa.com.
The market pregame, the opening bell, the crucial start of the trading day, key data, big interviews, squawk on the street, 9 a.m. Eastern, Sirius XM 112. The market pregame, the opening bell, the crucial start of the trading day, key data, big interviews, squawk on the street, 9 a.m. Eastern, Sirius XM 112. The market pregame, the opening bell, the crucial start of the trading day, key data, big interviews, squawk on the street, 9 a.m. Eastern, Sirius XM 112.
Welcome back, everybody. New developments in a U.S. Virgin Islands lawsuit against JPMorgan over Jeffrey Epstein. Let's get to Eamon Jabbers with the very latest. Eamon?
Hey there, Kelly. In a courtroom last night in New York, attorneys for the U.S. Virgin Islands targeted JPMorgan CEO Jamie Dimon as directly as we have seen so far in their case, alleging that the bank aided Jeffrey Epstein in his decades of sex crimes. The direct allegations against Dimon raise questions about how JPMorgan is going to defend itself here, and if this case will have any impact on Dimon's legacy as one of the most powerful titans of Wall Street. Last week, JPMorgan sued its own former executive, Jeff Staley, alleging that if there was any Epstein-related wrongdoing at the bank, it was done by Staley without the knowledge of other executives. In essence, JPMorgan was painting Staley as a rogue employee. But last night, attorneys for the U.S. Virgin Islands said they don't buy that argument. An attorney for the U.S. Virgin Islands said, if Staley is a rogue employee, why isn't Jamie Dimon? And argued Staley knew, Dimon knew, JPMorgan Chase knew. Of JPMorgan generally, the attorney said they broke every rule to facilitate his sex trafficking in exchange for Epstein's wealth, connections, and referrals. For its part, JPMorgan argued that, quote, all roads lead to Staley in this case, and they took issue with the idea that Jamie Dimon had any specific knowledge. JPMorgan has asserted that Dimon has no recollection of ever reviewing the Epstein accounts at the bank. A federal judge sided with the USVI against JPMorgan on one point and agreed that the USVI does have the ability to bring a case on behalf of anyone who was a resident there. The attorney for the U.S. Virgin Islands did not present evidence to prove her claim that Dimon knew about Epstein's crimes, but said in court that there will be numerous documents in this case that go beyond Staley's office, quote, to the executive suite. I reached out to JPMorgan for comment this morning on last night's hearing, but they declined to respond on the record. Back over to you.
How much longer should this hearing take place for in terms of any further allegations that we might hear?
Well, we're going to expect discovery to continue, and the U.S. Virgin Islands side is going to get a tranche of JPMorgan documents any day now. We're going to see more hearings next month, and we do expect this to go all the way through the fall, Kelly. So a lot more to come here on this story, and a big question mark here for Jamie Dimon. We'll hear from JPMorgan as soon as they respond to us. We'll tell you what they have to say.
All right, Eamon, thank you. Eamon Jabbers. Let's turn to Tyler Matheson now for the CNBC News Update. Tyler?
Kelly, thank you very much. President Biden is calling on Congress to give regulators more power to punish executives if their mismanagement leads to their bank's failure. But based on his response to a question from NBC News today, it sounds like House Speaker Kevin McCarthy isn't ready to jump on board.
Do you think that there's any congressional action that can be done in terms of the SVB and reaction to the SVB bank situation?
Well, I think we want to get all the facts, but it seems as though the regulators didn't do their job. I don't know if they need legislation.
The Justice Department, meantime, investigating the Chinese company that owns TikTok after it admitted that some of its employees had improperly obtained the data of 2 U.S. reporters. That is according to the New York Times. The Biden administration threatening to ban the app if it isn't sold, citing national security concerns over users' information and privacy. And YouTube has restored former President Trump's channel, saying it is balancing the continued risk of real-world violence with the need for voters to hear equally from major presidential candidates. There is no mention of, quote, guardrails like those put in place by Facebook when it reinstated Mr. Trump's account. Kelly, back to you. See you in a bit.
Tyler, thank you. I'm looking forward to it. It's been a wild week for the markets. Believe it or not, all 3 major averages are actually positive, although just by a hair for the Dow right now, which is down 300 points today. So how should you position now? Let's bring in Chris Murphy of Susquehanna. We talk about the options market in particular is saying here. And Randall Healy, he's Chief Investment Officer at Edgar Lomax, to talk about where people might see opportunity right now. Welcome to both of you. Chris, let's start with you. We like to check in with you on Quad Witching Day. The market's already casting a vote, I guess, though, about some concern there. We've seen the VIX jumping a little bit this week. How would you describe liquidity conditions?
Well, like you said, it has been a wild week in terms of each specific move on each day. We're still up on the week. But despite being up on the week, the VIX is either flat or maybe up small, and the VVIX, which measures VIX volatility, is up. So there's still a lot of concern out there. The main reason those VIX and VVIX are remaining on the higher end and staying firm while the market rallies is because investors are more worried about the downside tail options. During the inflation and the Fed and the higher rates of the last year, that was pretty well known and priced in, but at least from a volatility perspective, now we have this new kind of unknown kind of
bank issue, and that's leading to much more demand for downside put protection, which increases skew on something like the S&P 500.
You know, a lot's been made, Chris, of the fact that Treasury liquidity is not what it used to be. And people are obviously concerned about that, especially when you see 12 standard deviation swings multiple times in 1 week. Is that a problem that's unique to the Treasury market, or is it any sign of a broader concern, maybe starting with people backing away from perhaps equities or options this week?
No, you know, I think that whenever volatility is higher and uncertainty is higher, markets are going to thin out and they're going to get wider. But, you know, the use of ETFs, even, for example, the KRE ETF, sure, it's down a lot, but it did absorb a lot of supply, and it was used as a vehicle for directional exposure. So I think the increased usage of options and the increased usage of ETFs are actually, you know, in some ways adding to different avenues for investors to hedge their risk, and in some ways providing extra liquidity.
Has there been any direct impact from the banking problems onto Wall Street? In other words, onto the accounts that people have, the trades that they're making? Obviously, Charles Schwab has been one of the names in particular here. Do you discern any direct connection here?
No, not that we're seeing. I mean, obviously, we're trading with institutional clients that, you know, are backed and clearing through the OCC. So, you know, not really seeing anything too crazy. You know, when you have uncertainty over banks and liquidity, of course, volatility is going to be higher. Of course, the VIX is going to spike. But kind of going back to the U.S. Treasury volatility, if you're going to look at something like the MOVE index compared to where the VIX is, it's not even close. Equity volatility is hanging in there a whole lot more than Treasury volatility. If you look back historically and you were just to compare the MOVE index to the VIX.
So the forward rate versus kind of option spread, I don't know how you guys pronounce that for the lingo. When we start to see these things widening out, when we see overnight rates jumping, is that something that concerns you, or is it just kind of, okay, well, things seized up this week and we can kind of go back to normal?
Just look at the S&P is hanging in there because of those, you know, big tech stocks. So as of now, it's relatively contained. And once again, the S&P is at 1.5% this week, so we're not necessarily seeing quite as much of that kind of stress in the options and the equity volatility markets.
All right, Ray, did you know that was there? I'm just looking particularly at notes of Bank of America seeing some volume. Carnival, what do you say about that?
Yeah, so I'm here to drop off my vehicle. I think it was